the most out of it. This is actually once in a lifetime opportunity that you get to interact with such a great personality. So happy learning. Over to you, Tushar.
Thank you, Professor Sunny. It is a pleasure addressing your students. I remember last time I addressed, it was last year. Uh, Even before that, it was winter time, I remember, and I got such a good response from all the students. There were so many questions we discussed, and I still remember Professor Tej Pavan had arranged the whole thing. And I also look forward now. I understand these students are graduate students, so a lot of them are graduate students. So I will encourage you all to ask me questions on chat, which I can, reply to. And I will try to not use any jargons. So I won't use any over the top terminologies. Rather, I will stick to explaining the basics, so that all of you who want to make a career in entrepreneurship, or want to start something new, or even if you are planning to join a company which is into startup space, you will get benefited a lot. And so basically, I think I should also tell you a bit about entrepreneurship versus a career in a job, and how both the options are good options to make your career. So yes, so basically, see, if you are if you want to do a job, then you have options in a number of companies. Now what matters to you is how your career will go. So basically, from the age of 22 to 25 years, going all the way to 45 years, in these 15-20 years, you will rise to the top. And a lot of you will rise to the highest level in a job. And if not in 45 years, maybe in 50 years. But, if I compare job versus entrepreneurship, then in entrepreneurship, you have to work for your own self. And end of the day, if you compare these two with regards to the returns you get, then it is not fair to judge both of them, because the career which you will make in a job might be very different from the career which you will make in entrepreneurship. Now, just to tell you, the income tax which is applied on your salary is 30% in India. It is 40% in the US. It is 45% in UK. And if you stay for more than 7 years in UK and do a job, it is 55%. So on the income side, the taxes are quite high. 30% in India, 40% in US, 45% in UK, 55% after 7 years in UK. But if you are working in Singapore, your income tax is only 15%. So not only you are making money in a foreign currency, in the Singapore dollar or US dollar, uh, but your tax is also less. So you happen to save, like, if your salary in India is, suppose after 10, 12, 15 years, it is 50 lakhs in Delhi. So if you are spending 2 lakh rupees in your house per month, in 2 lakh rupees, you get a very good living in a city like Delhi. You save 25 lakh rupees per year. But in Singapore, if you are working in the same level, your salary will be $300,000. So out of $300,000, schooling is very costly, housing is very costly, car, if you buy a car, it is very costly. Uh, so, out of $300,000, you will end up spending $1,75,000 to $200,000. So you will save $100,000. Now, $100,000 is not much when you look at the living cost in Singapore, but it is quite a lot if you convert it into rupee terms. So if you come back to India after saving a lot of dollars in Singapore, so everybody please be on mute. Thank you. So if you save your money after working for 10 years in Singapore, naturally, in terms of rupees, you will have a lot of savings. Now, the income tax in Dubai is zero. So if you are working in Dubai and you are getting your $300,000, uh, your savings are more. But again, the cost of living is very high. And housing, maid, car, schooling, all these four things, you will end up spending almost $150,000 per year on these four things. But still in rupee terms, you will save a lot. Now, why I'm telling you everything about taxes and income tax? Because when you do a job, you earn income, and on that, income tax is applicable. If you do a business, the corporate taxes are applicable, but corporate taxes are calculated after deducting the expenses and costs. So that taxation is a different thing. Now, if you were to earn money by investing your money as an investment manager, then the tax applicable on your business is capital gains tax. Now, you will be surprised to see income tax 30%, 40%, 45%, and Singapore 15%. Capital gains tax across the world is very low. It is 10 to 20% in India and US. It is 0% in Singapore. 0%. So if you are investing your money in a stock market or real estate or commodities like copper, gold, aluminium, silver, oil, if you are betting your money on these asset classes, uh, or cryptocurrency, then the tax applicable in Singapore is zero. So there was a survey conducted by Forbes, the magazine. It calculated the total tax paid by the 500 richest people across a period of 25 years. And the net result was that because all of them earn a lot from investing the money, so the tax applicability is capital gains tax, and they have many ways to save tax. They can open their companies in tax haven places like Cayman Islands, like Cyprus, like Switzerland, and they can Ireland. Apple is a $2 trillion company. It files its taxes in Ireland because Ireland government has given a very sweet deal to Apple. So the total tax paid by 500 richest people across 25 years was 3.4%. So imagine if you are doing a job, you are paying 45% to 55% tax in UK. And if you are managing your wealth and investing the money, 3.4% tax across 25 years. So all the countries of the world have made it, they want to attract the wealthy people. Russia has a lot of wealthy businessmen. They are called oligarchs. London is the favorite place for these Russians to stay, and London calls all of them to build their mansions there, live with their yachts and their boats and everything, because it wants that these rich people should bring their money to London, so that London benefits. The property prices increase, and there is a lot of spending, so government earns a lot of tax. If it is not earning income tax or corporate tax, it is earning capital gains tax, or it is earning GST, or it is earning municipal taxes. So all of them want to call the rich people. And that's why the capital gains tax across the world is low, because all of them want to tell the rich people, you open your businesses in our country and invest your money in our stock markets, we will tax you very less. So why I'm telling you income tax versus capital gains tax is because as a startup, as a guy who would want to open a business, these things matter a lot. Now, why venture capital has taken so much of importance in the last almost 22, 23 years. So what happened was that 1999, the dot-com boom happened, and 2000, the dot-com bust happened. So a lot of dot-com companies, they raised huge amount of money, $100 million, and then suddenly the whole stock market system burst. And the central bankers of the world, like our Reserve Bank of India, like the Federal Reserve in the US, they manage the economy, they manage the money supply in the economy. And in 2008 the Lehman Brothers crisis happened, and in 2019 the COVID crisis has happened. All this while, all through dot-com boom and bust, all through Lehman Brothers crisis, and then COVID crisis, there are two trends which have taken firm root across the global economy. The first trend is technology is marching in our homes. Technology has got entrenched. Technology businesses have got the most increase in value, and technology is marching in our homes. And second aspect is that uh, governments have made it very easy for financial firms to take debt from the government. I will explain you what it means. It means that the economy, the fundamentals of the economy are not so good. So the economy requires a lot of debt or loans in easy interest rates, with easy interest rates. And to provide all these loans so that the economy keeps on growing, it doesn't come into a recession, the government prints a lot of cash. They print a lot of currency. They give it to financial firms like hedge funds, and that money gets invested in asset classes. So a hedge fund which is putting in $1 million of his own money can borrow 90% debt. So the government will give him $9 million of debt. So the hedge fund puts in only 1 million, takes $9 million of debt from the government bank at a interest rate of 0.5% per year. That's it, 0.5% per year. Now it has $10 million worth of corpus. It invests that money in stock markets, in commodities, in forex transactions, which means betting on other currencies, in real estate, and now in cryptocurrency. So this huge volume of money, right from Lehman Brothers crisis 2009 till 2021, the American government alone has printed $25 trillion worth of currency. All that currency is, uh, it's sloshing around in the global economy. It is chasing returns. It is chasing asset classes. And there are bubbles. There are real estate bubbles. There are stock market bubbles. There are commodity bubbles. So, suddenly the price of copper will rise 5 times. Cryptocurrency, Bitcoin was nothing when it came in 2010 and 11. And suddenly it is now worth $50,000 per Bitcoin. And so those people who would have bought bitcoins in 2014 when it was not even $1, now from $1 to $50,000. If somebody had taken 100 bitcoins, he would have made amazing kind of return. And cryptocurrency is not even a asset class; it is a fake asset class because it doesn't have any real value. You can't use that currency. It is a number on the screen on which you are betting. So because it doesn't have any value, the governments are against it. Indian government, Chinese government, many African countries, they are against. But the flow of money for betting is so huge that cryptos, they rise so much, they fall so much. They rise on news, they fall on news. Now, amongst all these asset classes, one asset class is venture capital. So if you want to invest your money, you can put it in a stock market, you can put it in bonds, which are safe kind of investments. You can put it in cryptocurrency, which is very volatile. You can put it in commodities. Commodities run in cycles. So gold was rising for 8 years, then it was falling for 4 years. Oil fell to $18 per barrel. Now it is $75 per barrel. So they have cycles. And so, one of the asset classes where you can put your money expecting a return is venture capital. And the beauty about venture capital is uh, that because venture capital chases startups and new companies which are trying to create something new, and they are trying to, as we call in our terminology, they are trying to disrupt the market. So there are established. So suppose uh, Tatas have Tata Motors, and Tata Motors is an established company. Now suddenly a new company will come like Tesla, and they are trying to bring in energy efficient batteries, and cars run with energy efficient batteries. So they are trying to disrupt the market. Venture capital. So if you put your money in a fixed deposit in a bank, FD, this is the safest kind of investment. The bank will give you 4%, 4.5% post tax return every year in India. If you put your money in a US bank, you will get 0.5% per year. If you put your money in euros, you will get 0.25% per year, which is practically zero. If you put your money in Japanese yen, you will have to pay the bank to keep your money. The interest rate is negative in Japan. So globally, lazy investment like fixed deposits, countries are kind of pushing you not to do that. They are telling you to take out your money from the bank and put it in productive uses, open a business, um, or invest that money in asset classes. It is a nightmare for the retired people, because where will they go? You know, but the European countries and Canada and UK and some parts of US, they have welfare state. So they say that you keep on working till 60. After 60, we will take care of you. So you will get doles, you will get housing, but that is not there in many countries. So what will the old people do in countries like Asia, like China, India? So there is a very conscious uh, you know uh, people are very conscious that for the retirement they need to save. So they save a lot of money in the bank, and that is a traditional way. They put some money in mutual funds, in systematic investment plans, in LIC policies, and some in stock markets. So, but the financialization of the economy, which means that money comes from savings from a bank into the stock markets, into real estate, into investments. That's called financialization of the economy. That is a trend which is going on since many years in India also. So there were 3.5% Indians who have put their money in stock markets. Now it has increased to 5.5%. So people are, there is a trend. Now venture capital means that you put your money into companies which are not listed on the stock exchange. So if you take shares of that company, 10%, 15%, then you can't sell it anytime because these shares are not traded on the stock exchange. So it's a very risky investment. Not only you have to choose a good company which has a chance to grow, you also have to exit that investment at a good capital gain profit, and you have to ensure that you get the exit also. So it is very risky. So venture capital is the riskiest kind of investment for an investor. But why do they do it if it is so risky? Because the average returns generated by venture capital for investors, there was a study done by Red Seer Consulting. The average return generated by a venture capital fund across a period of 8 years uh, in startups was 54% per year average. So, how to raise funds? I will just talk about this particular slide. So, basically, investors, they venture capital funds, they raise money from outside people. They raise money from pension funds, endowment funds, from family offices, from angel investors, and they tell them, we will put your money in startups, generate a return, and give you back the money in 5 to 8 years. So these investors, when they raise money from these parties, then they also tell them how will they invest the money, and that is called investment thesis. And this investment thesis is given on the website of the VC funds. So how will a typical investment thesis look? We are an early stage fund investing in seed, at seed level or pre-series A, with a ticket size of up to $0.5 million, with sectoral focus of education technology, financial technology, agriculture technology, space technology, deep tech, artificial intelligence, machine learning, for a preferred market, which is India. Now, this is just one example. So this is how the thesis looks. कितना पैसा डालेंगे? What would be that ticket size? At what stage of the company they will put in the money? Which market will they prefer? Which sector will they prefer? And that is the thesis. So they, a lot of companies keep coming to these VC funds every day. So naturally, they have a very good experience about, uh, about seeing the business of uh, v- those companies. Now, let me show you this slide. The first thing which the investor wants to know is the problem statement you are solving. Like, what is the problem faced by humanity, by the customers, which you are solving? Now, if you are wanting to solve an environmental problem, you might have a startup about electric vehicles. So, you are putting electric vehicles on the streets. So, you are solving the environmental problem. Now, if people can't find a taxi, so Uber comes up with an app. And now, through the app, using the smartphone, you are able to get taxis, get the pricing, get the map, everything. So, the problem statement is about availability of taxis. So, this is the more fundamental the problem you are solving for humanity, the more chances that you will end up becoming a huge company. Now, if you want to solve a very small type of problem, naturally the scalability won't be too high. you will end up remaining not a very big company. So that is most important. The second thing is the solution. Third thing is the team. Now, lot of funds, they don't invest in single founder companies. They say single founder nahi chahiye. So, your team should be balanced. Two or three co-founders. Then, if you don't have a technology guy in the founders, then, you can take a technology person, make him a chief technology officer, CTO. So that thing you can solve. So team is the most important, because the VC fund guys, they always say that we bet our money on people. End of the day, we are backing people. So, if you create a wrong product, if the team is good, they will better the product. So that is the importance of team. But if the team is not good, then, even after creating a good product, they won't be able to make much business out of that, or they won't be able to scale it. So team is the most important. Then market size, as I told you, if you are in a very small market, naturally your revenue won't go very high. So if the revenue won't go very high, the valuation of the company won't go very high. Then the product, what is the service or the product you have created? If you have already created it, you can give a demo to the investor online. Then the business model, which is the most important. How will you earn from that product or service? That's like, will you earn commission based, or monthly lease rentals, or yearly based? Uh, so all these things, they form a part of the business model. Then the traction. Traction means, what is your customer growth? What is your revenue growth? Uh, how much revenue and operating profit you are doing as of now? Then competitor analysis. Who's your competition and your competitive advantages? How are you different and better from the competition? Then the financial projections. You have to give 5-year projections, like, this much money will go in the first 1.5 years. It will generate a revenue of this much over a 5-year period. This much will be the operating profit, and this will be the net profit. And in fact, when we do the valuation of a company, how to value a company, we create 5-year projections. On the basis of those 5-year projections, we calculate the free cash flow available to the company in 5 years. Free cash flow, which means net cash flow, incoming cash, outgoing cash, and the net cash. And then we calculate the present value of those free cash flows. So that is called discounted cash flow valuation. So we do that when we need to value the startups. We have to create a 5-year financial model. Then the ask, how much funds you are asking for, dollars may, rupees may, and the use of funds. How will you use the funds? How much will go into marketing? How much will go into um, human resource? How much will go into building technology, and so on? And the last thing is the future roadmap. A future roadmap can be, how many customers will you achieve in the next 3 months? When will you open a new office? So, all those roadmaps which you have in mind, that. So, this is the basic information needed by investors once they are looking to fund you. And I have discussed all of them. So, these slides are. So, this is it. Apart from venture capital, there are other investors also in the market. There are family offices, there are angel investors, there are accelerators, incubators. There is government money, like Government of India gives you 25 to 50 lakhs money. Uh, but that is a kind of a grant, which is takes a long time to get. So all these options are available, and if you think you are starting a company, and instead of diluting your equity, you can take loan, you can take a debt. So it is not so easily available for new companies. No, you should in Indian banks they will ask you for a real estate. They will take the real estate as collateral. Then they will ask you for cash flows. That how much cash flows does your business have? Will those cash flows be able to service the debt, the interest rate, and the principal? And they also ask for 3-year audited financials. So they ask for companies who have been in the existence since at least 3 years. So those options are not easily available, debt options. But if you are taking money from Y Combinator, which is in the US, then they give you $100,000 to $300,000, and in fact you can return that money to them also as debt. So that kind of an option is available in US and Israel, which is the Y Combinator. Otherwise, it is not so much available. If you go to Y Combinator in the US, you will present your pitch on the stage for 10 minutes. After 10 minutes, these guys on the stage, they start prodding the investor. Check lao, write the check. And people write checks, $100,000, $50,000, $300,000, after hearing the company for 10 minutes. So India, the ecosystem is there, but always remember that we are a high population country. In everything there is a line. Everything there is a line. So there were 28,000 startups registered with Startup India 1.5 years back, and today it is 50,000 startups. From 28,000 to 50,000 startups in 1.5 years. So, so the investor who works in India, see, uh, outside India, he's chasing the startup. In India, the startup is chasing the investor. So uh, that is the typical nature of our country, and cost of capital is high because of legacy reasons, which I just told you.